Welcome back to The Art of Progress. In today's video, we're diving deep into the investment wisdom of one of the most successful investors in history, Warren Buffett. We're exploring the Essays of Warren Buffett, a collection curated by Lawrence A. Cunningham that distills decades of Buffett's letters to Berkshire Hathaway shareholders into timeless lessons on investing and business. If you're looking to sharpen your investment strategy, stay tuned because this video is packed with insights that could change the way you think about investing. The Essays of Warren Buffett serves as a curated collection of Warren Buffett's letters to Berkshire Hathaway shareholders, offering a deep dive into his investment philosophy and business acumen. Lawrence A. Cunningham has organized these essays into thematic sections, making Buffett's wisdom accessible to readers who wish to understand the principles that have guided one of the most successful investors in history. This book isn't just about investing. It's about adopting a mindset that prioritizes long-term value, ethical business practices, and disciplined decision-making. Part 1. Corporate Governance. Corporate governance is a cornerstone of Buffett's philosophy, and in this section, he emphasizes the importance of management and board members acting in the best interests of shareholders. Buffett argues that a company's leadership should always think like owners, prioritizing the long-term health and profitability of the business over short-term gains. He is critical of executive compensation practices that reward short-term performance at the expense of sustainable growth. Key essays delve into the role of the board of directors. Buffett believes that board members should have substantial personal investments in the company, which ensures their interests align with those of shareholders. He advocates for a board that is independent, active, and engaged in meaningful oversight. Management's responsibility. Buffett emphasizes the need for clear and honest communication between management and shareholders. He is a strong advocate for transparency, arguing that shareholders deserve to know the full story about a company's operations and financial health. This level of transparency builds trust and fosters a long-term partnership mentality between management and shareholders. Part 2. Corporate Finance and Investing. Summary. Buffett's approach to corporate finance is deeply rooted in the principles of value investing, a strategy he learned from his mentor, Benjamin Graham. Central to this approach is the concept of intrinsic value, which Buffett defines as the present value of a company's future cash flows. He contrasts this with market price, which can be heavily influenced by speculation and short-term factors. Key essays in this section include intrinsic value. Buffett argues that understanding intrinsic value is crucial for making informed investment decisions. He explains that investors should focus on what a company is truly worth, rather than being swayed by the whims of the market. Margin of safety. A key principle inherited from Graham, the margin of safety refers to buying stocks at a significant discount to their intrinsic value. This provides a buffer against errors in analysis or unforeseen market downturns, effectively minimizing risk. Efficient market hypotheses, or EMH. Buffett challenges the widely accepted EMH, which suggests that markets are always perfectly efficient. He contends that markets can be irrational, leading to overvalued or undervalued stocks. This inefficiency creates opportunities for astute investors to capitalize on mispriced securities. Part 3. Business Operations. Summary. In this section, Buffett shares his thoughts on what makes a business truly exceptional. He emphasizes the importance of economic moats, competitive advantages that protect a company from its rivals. These moats might include brand loyalty, cost advantages, or regulatory barriers that make it difficult for competitors to erode the company's market position. Key essay cover. Economic moats. Buffett explains that companies with strong economic moats are more likely to deliver consistent, long-term returns. He looks for businesses that can maintain their competitive edge over time, even in the face of new entrants or changing market conditions. Management quality. Buffett argues that a company's success is often tied to the quality of its management. He favors managers who are competent, honest, and shareholder-oriented. In his view, good managers allocate capital wisely, avoid unnecessary risks, and focus on long-term value creation. Part 4. Financial Reporting and Accounting. Summary. Buffett places great importance on financial reporting and accounting practices, advocating for straightforward and conservative accounting methods that provide a clear picture of a company's financial health. He warns against the dangers of relying on non-GAAP metrics, which can obscure the true state of a company's finances. Key essays include Earnings Quality. Buffett stresses the importance of understanding the quality of a company's earnings rather than focusing solely on reported profits. He looks at how those earnings are generated. Are they backed by strong cash flows, or are they the result of accounting gimmicks? High-quality earnings are sustainable and indicative of a company's long-term viability. Conservative accounting practices. Buffett advocates for the use of generally accepted accounting principles to ensure transparency and consistency in financial reporting. He warns against aggressive accounting techniques that can inflate earnings or mask underlying issues. For Buffett, conservative accounting is a sign of a well-managed company that prioritizes long-term health over short-term optics. Part 5. Investment Philosophy. Summary. Buffett's investment philosophy is characterized by a focus on long-term value, discipline, and an understanding of one's own limitations. He believes that successful investing requires patience and the ability to stick to a well-considered strategy even when the market is volatile or other investors are chasing trends. Key essays include long-term focus. Buffett is known for his buy and hold strategy, where he invests in businesses with the intention of holding them indefinitely. He argues that the best way to build wealth is to invest in strong companies and let them grow over time, rather than trying to time the market or chase short-term gains. Circle of competence. Buffett advises investors to stay within the circle of competence areas where they have a deep understanding of the industry or business. By focusing on what they know best, investors can make more informed decisions and avoid costly mistakes. Partnership mentality. Buffett views his relationship with Berkshire Hathaway shareholders as a partnership. He communicates openly and honestly with them, treating them as co-owners of the business. This partnership mentality extends to how he thinks about his investments, favoring companies that treat their shareholders with respect and transparency. Part 6. Mergers and acquisitions. Buffett shares his thoughts on mergers and acquisitions, emphasizing the importance of discipline and a clear strategic vision. He is critical of acquisitions that are motivated by the desire to grow for growth's sake or that involve paying exorbitant prices for companies. Key essays cover acquisition strategy. Buffett outlines the criteria he uses when evaluating potential acquisitions. He looks for businesses with consistent earnings, strong management, and a reasonable purchase price. He prefers to acquire companies that have a clear, sustainable competitive advantage and can be operated with minimal disruption. The dangers of overpaying. Buffett warns that overpaying for acquisitions can destroy shareholder value. He believes that companies should only pursue acquisitions that make sense from a financial perspective, and he's wary of deals that are driven by the need to keep up with competitors or to satisfy short-term market expectations. Part 7. Accounting policy and tax matters. In this section, Buffett discusses the importance of transparent accounting policies and the impact of taxes on investment decisions. He advocates for simplicity and clarity in financial reporting, and he emphasizes the need for careful tax planning. Key essays include straightforward accounting. Buffett argues that companies should avoid complex or opaque accounting practices that can mislead investors. He believes that financial statements should be easy to understand and that companies should err on the side of conservatism when reporting earnings. Tax efficiency. Buffett discusses the importance of considering taxes when making investment decisions. He highlights the impact of capital gains taxes on long-term returns and suggests strategies for minimizing tax liabilities, such as holding investments for longer periods and favoring companies that return capital to shareholders through dividends and buybacks. Part 8. Shareholder communication. Buffett places a high value on clear and honest communication with shareholders. He believes that shareholders should be treated as partners in the business and that they deserve to be fully informed about the company's operations and financial performance. Key essays cover annual letters to shareholders. Buffett's annual letters are a model of transparency and clarity. In these letters, he provides a candid assessment of Berkshire Hathaway's performance, discussing both successes and challenges. He uses these letters to educate shareholders about the company's strategy and to set realistic expectations for the future. Transparency and honesty. Buffett argues that companies should be forthright in their communications with shareholders, avoiding jargon and providing information that is both useful and understandable. He believes that this level of transparency builds trust and strengthens the relationship between management and shareholders. Part 9. Alternative investments. Buffett discusses alternative investments such as real estate, commodities, and other non-traditional asset classes. He's generally cautious about these types of investments, as they often carry higher risks and require specialized knowledge. Key essays include real estate and commodities. Buffett explains why he generally avoids investments in real estate and commodities. He prefers businesses that generate strong, predictable cash flows, rather than assets that are subject to significant price fluctuations or that require active management. The risks of alternative investments. Buffett warns that alternative investments can be highly speculative and advises investors to stick to areas where they have a deep understanding. He emphasizes the importance of evaluating the risks and rewards of any investment and of avoiding opportunities that seem too good to be true. Part 10. Market Conditions and Management Practices. In this final section, Buffett reflects on market conditions and the role of management in navigating economic cycles. He stresses the importance of maintaining a long-term perspective and of making decisions that are in the best interests of the business, regardless of short-term market pressures. Key essays cover navigating market cycles. Buffett provides insights on how to stay disciplined during periods of market volatility. He advises against trying to time the market, instead advocating for a consistent, long-term investment approach. Management's role in market conditions. Buffett emphasizes that management should focus on the long-term health of the business rather than trying to cater to short-term market expectations. He argues that businesses should be run with an eye towards sustainable growth and value creation, even in the face of economic uncertainty. The book concludes with a synthesis of Buffett's overall philosophy, reinforcing the theme of discipline, long-term thinking, and value investing. It highlights how these principles have been successfully applied at Berkshire Hathaway and how they can be applied by individual investors as well. Buffett's essays offer timeless wisdom that is applicable to both individual investors and corporate managers. By focusing on intrinsic value, maintaining a margin of safety, and investing with a long-term perspective, investors can achieve sustainable success. The key to Buffett's approach lies in its simplicity and its emphasis on rational decision-making, which has allowed him to consistently outperform the market over the course of his career. What do you think about Warren Buffett's investment philosophy? Do you agree with his approach, or do you have a different strategy? Share your thoughts in the comments below, and if you found this video helpful, make sure to give it a thumbs up and subscribe for more insights on investing and financial wisdom. Thanks for watching, and until next time, happy investing!